So let's discuss the taxes for this compliances and overview of a non-resident in India. The first point of a taxation structure is residential status. So let's understand some differences that are there in the FEMA, that is the Foreign Exchange Management Act, which regulates investment in and out of India, and under the Income Tax Act. For tax purposes, the residential status in India, there are three options: that you could be an ordinary resident, you could be a resident but not an ordinary resident, or you could be a non-resident. Each of this status decides what level of income is taxed in India. Under FEMA, however, there are a different set of rules. So residential status under FEMA and under the income tax could be different for you. So FEMA will determine what you can invest, how you can invest, or if there are any restrictions. Income tax will determine whether your income in India is taxable or not, or whether your global income is taxable or not. Under FEMA, there are two main categories of residency. A person could be a person resident in India or a person resident outside India. Now, there is a third category, that is a person resident in India but not permanently resident. Those are for employees working in India. We will not cover that because of the nature of this webinar. Now, note that FEMA residents and income tax residents both are totally independent of each other. So you could be a resident under income tax, but you could be a non-resident under FEMA and vice versa. And combined reading of both the laws will help you understand what your situation is. Now, there is a link at the bottom of this slide that will allow you to calculate your residential status, whether you are an ordinary resident, not ordinary, or a non-resident in India. That said, as I said, residential status determines what income is taxed in India. For residents, global income is taxed. With residents, I mean ordinary residents. Ordinary residents, global income is taxed. Whether you earn it in India, whether you earn it in any other country, it is taxable in India. For non-residents, income that accrues outside India, and it should not be received in India. If you earn income outside India, you receive it outside India, it is not taxed in India. For not ordinary residents, that is the midway, the income that accrues outside India, basically you earn any income outside India, but if the business or profession is set up in India, then it is taxable in India. Now note that any income received in India, or if it is accruing or arising in India, it is always taxable. So if you earn income outside India, but you bring it back directly to India, you can though route it through your bank account in a foreign country, that would not be considered as received in India. But if you directly receive your income in India, then it is taxable. Whether you are a resident, non-resident, doesn't matter. In India, though, there could be no tax payable if your income, right now, let's talk about tax return filing. Even if there is no tax payable, Indian basic income tax exemption limit is 2,50,000 rupees. Now, even if your income is more than 2,50,000 rupees, there are situations where you would not have any tax liability in India. But that doesn't mean that you do not file a tax return in India. So if your income exceeds 2,50,000 rupees, you are required legally to file your tax return, whether or not tax is payable or not, doesn't matter. Now, since we have an idea of income tax, let's go to FEMA. FEMA basically works on regulations issued by the RBI. Now, these are notified either by the Reserve Bank of India or by the central government through its gazette. Now, what these regulations do is allow or restrict a transaction where foreign exchange is involved. Like I said, it works in two ways. Non-residents could be investing in India, that is an inward transaction, and residents who are investing outside India. So FEMA restricts or allows certain transactions based on what type of foreign exchange is coming into India or outside India. For non-residents investing in India, the terms OCI, NRI, and PIO, that is overseas citizen of India, non-resident Indian, and a person of Indian origin, these are very important as they decide what is allowed under FEMA to be done or if it is restricted. Investments under FEMA could be either repatriable investments or non-repatriable investments. Repatriable basically means that whatever original money you put in, original investment that you put in, could be freely remitted outside India. So that money will easily be transferred outside India without much compliance. Now, what is non-repat then? Non-repat is basically if you put some money in India and that money is not free to be transferred outside India. You can reinvest it in India after you sell your original investment, but you cannot directly transfer it. However, there are rules that allow transfer of non-repat money outside India, but we will be covering them later on in this webinar.